January 1st, 2016. You decide, this is the year I start investing. But you hesitate, you wait. You research. Someone else invests $5,000 that exact day. Fast forward to January 2026. You are still researching them. Their $5,000 is now $13,267. The best time to start investing was 10 years ago. The second best time is today. If you've been thinking about investing but haven't started, this video is for you. Whether you have $50 or $5,000, whether you're 22 or 52, what if I lose everything? What if I pick the wrong stocks? What if I'm too late? Look, research shows that people who wait until they know more never actually start. Meanwhile, those who start imperfectly are the ones who build wealth over time. Today we are covering everything you need to know, how to choose and open a brokerage account, what to actually invest in, understanding your risk tolerance, the biggest beginner mistakes, and your 48-hour action plan to get it done. Let's get started. The first step is to open a brokerage account. Think of it like a special bank account that lets you buy stocks and ETFs. The good news: they're free to open, it only takes about 15 minutes, and your money is insured up to $500,000. For beginners, I recommend Fidelity, Charles Schwab, or Vanguard. Fidelity is great for educational resources. Charles Schwab is excellent for long-term growth and research tools. And Vanguard is the go-to for low-cost index fund investing. My recommendation? Pick either Fidelity or Schwab. Both are fantastic. Don't get stuck here. Just pick one and move forward. To open your account, go to their website, click Open an Account, and choose Individual Brokerage Account. You'll need to provide your name, address, social security number, and some employment info. Then, you link your bank account and transfer some money, which usually arrives in 1 to 3 days. That's it. It takes about 20 minutes total. And no, you don't need a lot of money to start. You can begin with $100 or even $50. Your money is safe and insured, just like at a bank. All right, now for the part where most beginners get stuck: what to actually buy. The key is to keep it simple. You want broad market exposure through low-cost ETFs. Buying Apple's stock is like betting on just one company. But buying an ETF like VU is like owning a small piece of 500 of the biggest companies at once. It's like owning every horse in the race instead of betting on just one. Now, you might hear about index funds versus ETFs. What's the difference? Index mutual funds often have high minimums and only trade once a day. ETFs, on the other hand, trade all day long like a stock and have no minimums, especially with fractional shares. For beginners, I always recommend starting with ETFs. They're just more flexible. So, what are the best ETFs for new investors? First, there's VOO, the Vanguard S&P 500 ETF. It holds the 500 largest U.S. companies and has historically returned about 10% annually. It's perfect for simplicity. Then there's VTI, the Vanguard Total Stock Market ETF. This one holds the entire U.S. market, over 3,500 companies, giving you maximum U.S. diversification. And for global exposure, there's VXUS, which holds companies outside of the U.S. Here are 3 simple strategies. Strategy A, the ultra-simple approach: put 100% of your investment into VOO or VTI. Strategy B, the global approach: 70% in VTI and 30% in VXUS. And strategy C, if you want to add some stability: 60% VTI, 30% VXUS, and 10% in a bond ETF like BND. The critical point is not to overthink VU versus VTI. They are both excellent. Just pick one and start. Before you invest a single dollar, you need to answer one question: how much volatility can you handle? This is called the sleep test. Imagine your $5,000 investment drops to $3,500 in a market downturn. If your response is, "Markets fluctuate, I'm holding," you have a high risk tolerance. If you feel uncomfortable but you'll hold, that's moderate. But if you're thinking, "I can't sleep, I want to sell," you have a low risk tolerance, and there's no shame in that. A conservative portfolio you stick with is always better than an aggressive one you abandon in a panic. Your time horizon is the most important factor. If you need the money in less than 3 years, don't invest it in stocks. Use a high-yield savings account. If your timeline is over 10 or 20 years, you can afford to be more aggressive with 90 to 100% in stocks. Do a quick check. Do you have a 10-plus year timeline? A 3 to 6 month emergency fund? Stable income? And can you handle a 30% drop in your account? If you checked for or 5, you have a high risk tolerance. 2 or 3, moderate. 0 or 1, low. Now let's talk about the biggest beginner mistakes so you can avoid them. Mistake number 1, trying to time the market. Waiting for the perfect moment to buy just means you'll miss out on gains. The fix is dollar cost averaging. Invest a set amount, say $500 every month, instead of trying to guess the market's next move. Mistake number 2, panic selling. The market drops 25%, you get scared and sell at the bottom, and then you miss the recovery. The fix? Write this down. I will not sell during downturns. Short-term losses are temporary. Mistake number 3 is chasing hot stocks. By the time you hear about a stock that's up 300%, you're usually buying at the peak. Stick to broad market ETFs for your first 1 to 2 years. Mistake number 4, not investing enough. Investing $25 a month for 30 years might get you $56,000. But $500 a month could grow to over $1.1 million. Calculate backwards from your goal and adjust your budget. Mistake number 5 is checking your account too often. Daily checking just increases anxiety and leads to bad decisions. Aim for monthly checks at most. And the final, most crucial mistake, not having an emergency fund. Never invest money you might need soon. The required order is pay off high-interest debt, save a starter emergency fund, get your employer's $401k match, build up 3 to 6 months of expenses, and only then should you start investing in a brokerage account. Okay, let's make this real. Here is your 48-hour action plan. Today, in the next 2 hours, open your brokerage account, link your bank, and start a money transfer. Tomorrow, choose your strategy. Is it 100% VTI? Or maybe 70% VTI and 30% VXUS? Write it down. Then, spend 30 minutes watching tutorials on your new brokerage platform about how to search for ETFs and place orders. On day 3, when your money arrives, it's time to place your first order. Log in, search for the ETF ticker like VU or VTI, click buy, enter the dollar amount you want to invest, and submit. The best time to do this is during market hours from 9:30 a.m. to 4 p.m. Eastern Time. Finally, set up automatic monthly investments and put a reminder on your calendar to check in at 3 months, 6 months, and 1 year. Your goal for the first year is to stay consistent. Here is a hard truth. Research shows that 95% of people who watch investing videos never start. Of the 5% who do, 80% quit within a year. But the 1% who start and stick with it, they are the ones who build life-changing wealth. The difference isn't intelligence or luck. It's that they started and they didn't stop. 10 years from now, you can look back and be so glad you started today. So here's your task for the next 10 minutes. Pause this video, go to Fidelity or Schwab's website, and click Open an Account. Complete the process. Then come back here and drop a comment below saying, "Account opened" with today's date. I read every single comment and I'll respond with guidance. Subscribe for more practical investing content every week, and hit that like button if this video helped you take action. Share it with someone who you know needs to start investing. Your future self is watching you right now, hoping you'll make the decision they'll thank you for. The best time to start was 10 years ago. The second best time is right now. Thanks for watching. I believe in you. Now go make it happen.